So imagine logging into your brokerage account and watching $240 billion of your personal wealth just evaporate in a single afternoon.
I mean, that is a level of volatility that most of us literally cannot comprehend.
Right, but then imagine trying to figure out how to afford, like, a standard Hershey bar at the corner store on that exact same day.
Mm.
Today, June 24th, 2026, we are looking at an economy that is completely split in two.
Yeah, we have a really fascinating stack of sources today showing how these different parts of the economy are just colliding violently.
Exactly. You have the hyper-valued futuristic architecture of tomorrow slamming right into the ground-level reality of everyday consumers.
Hmm.
And, by the end of this conversation, you're going to understand the invisible mechanisms driving both the highest echelons of the stock market and, well, the price of your local conveniences.
And we really have to start at the absolute bleeding edge of the market because the sheer scale of the wealth fluctuations happening up there right now is just staggering. Take Elon Musk's recent financial whiplash, for example.
Oh man, that timeline was brutal. I mean, on June 12th, SpaceX has that highly anticipated public debut on the NASDAQ, right? And the company hits a $1.77 trillion valuation.
Right. And that specific event instantly propelled Musk past the $1 trillion personal wealth mark, which is historic, but it was incredibly short-lived. Because by June 22nd, a brutal tech sell-off ripped through the market, and he lost an estimated $240 billion in a single day.
240 billion. That is, I mean, that's the GDP of a medium-sized country just wiped out.
Mhm.
But the underlying vulnerability there is his lack of traditional diversification, isn't it?
Oh, absolutely. Nearly 80% of his entire net worth is tied up in SpaceX equity, with like another 12% sitting in Tesla. So when Wall Street suddenly starts questioning the massive capital spending required for AI infrastructure, highly concentrated wealth takes the absolute brunt of that panic.
They want to see actual timelines for returns on all this AI hype. But it's wild to contrast that emotional, hype-driven stock volatility with the companies that are quietly operating as massive cash machines right now.
You're talking about the hardware manufacturers. They are functioning in a completely different reality. Look at Micron Technology. They just reported a gross margin of 84.9%.
Wait, 84.9%.
Right.
How is a company that makes physical hardware pulling software-level profit margins? I mean, building memory chips requires massive factories, complex supply chains, enormous overhead.
It does, but they are retaining more profit after the cost of goods sold than a pure software company like Meta. They're even outperforming NVIDIA on that specific metric. And the mechanism enabling that is a contractual lever called a strategic customer agreement, or SCA.
Okay, so how do these SCAs actually change the math for them? Because historically, memory chips were a notoriously cyclical commodity, right? Like prices boom, they overproduce, prices crash.
Exactly, but because data center operators are currently in this desperate race to secure high bandwidth memory for their AI processors, Micron transformed that commodity into a highly controlled asset. The SCAs effectively establish firm price floors.
So they basically lock in the premium pricing, regardless of broader market swings.
Yep. Micron expects this structural market tightness and these premium prices to persist well beyond 2027.
Well, hold on. I need to push back on this market reaction to hardware makers because the investor psychology seems kind of broken right now. Let's look at Broadcom.
Right, their recent earnings report.
Yeah, they just booked $10.8 billion in AI semiconductor revenue, and they issued guidance predicting $16 billion for the next quarter. Despite those massive numbers, Wall Street actually sold off the stock. I mean, are you telling me investors punish Broadcom just because they didn't provide a massive enough surprise? Have they become addicted to explosive beats and raises?
It looks like that on the surface, but the sell-off is actually less about an addiction to surprises and more about the structural bottlenecks hidden inside Broadcom's sales process. To secure those massive chip orders, Broadcom had to set up a special purpose vehicle with alternative asset managers, Apollo and Blackstone.
Wait, let me pause you there. A special purpose vehicle for computer chips. So Broadcom is essentially acting as a shadow bank just to move their own inventory.
That is the crucial takeaway here. They are orchestrating debt financing so their clients can actually afford the hardware. The frontier AI labs are attempting to buy hardware at a scale that severely strains their own balance sheets.
So the chip makers are being forced to engineer alternative financing pipelines just to keep the sales moving. And that complex financial engineering signals to Wall Street that the limitless, easy money phase of AI hardware might be hitting a ceiling.
Exactly. And the financial ceiling is only half the problem, right? The physical ceiling is power generation. We're seeing major corporations bypass the public grid entirely to solve this.
Oh, like the Chevron deal. They just finalized a 20-year agreement to supply natural gas directly to a new Microsoft data center in Texas. And this facility is being built completely behind the meter, meaning it generates its own power locally, totally isolated from the broader electricity infrastructure.
And that isolated energy demand feeds directly into the broader macroeconomic fight currently dominating Washington. You have Treasury Secretary Scott Bessent heavily promoting his 333 plan.
Right. The administration's stated goal is to achieve 3% GDP growth, maintain a 3% deficit to GDP ratio, and produce an additional 3 million barrels of oil per day to fuel this industrial expansion.
But the prediction markets are fundamentally rejecting the mathematics of that plan. Traders on Kalshi currently give the U.S. only a 14.2% chance of hitting that 3% GDP growth target this year.
The skepticism there is heavily anchored in the geopolitical hangover from the recent U.S.-Israel war with Iran. I mean, wholesale Brent crude has retreated back to pre-conflict levels, sitting around $74 a barrel. Yet the price average U.S. drivers are paying at the pump is stubbornly hovering around $3.93 a gallon.
The lag between wholesale crude drops and retail gasoline prices always creates friction, but the current gap is sparking intense political crossfire. Donald Trump is actively accusing companies like Chevron and Exxon of price gouging consumers.
Yeah, he is demanding investigations into why the pump prices haven't matched the wholesale market correction. But while politicians are arguing over national price averages, a retail giant is quietly weaponizing this exact friction.
You're talking about Costco.
Think about the last time you went to Costco. You likely waited in a massive line of cars just to get gas. They are seeing record fuel volumes specifically by undercutting the broader market. They are not trying to maximize their margins on a gallon of gas.
No, they're using cheap fuel as a mechanical lever to drive incredible foot traffic into their warehouses. Because securing recurring revenue is the ultimate shield against macroeconomic volatility.
Exactly. By operating the gas pumps as a loss leader, Costco has pushed their highly lucrative executive memberships up to 41.2 million subscribers. They shift their reliance away from unpredictable consumer spending and anchor their entire business model to a $130 annual subscription fee.
It's a brilliant structural move. And speaking of smart subscriptions that actually deliver structural value, you can find Financial Candy, Brain Candy, and classic audiobooks at clarineratio.com.
It is a fantastic way to access premium content without waiting in a massive warehouse gas line.
Right.
But following that consumer journey from the gas pump into the actual retail sector, we are seeing those macroeconomic pressures materialize in highly specific, sometimes contradictory ways.
Definitely. Look at Gap Inc. They just reported a mixed bag of earnings that confused plenty of analysts. The flagship Gap brand soared, with sales up 10%. However, Old Navy, which accounts for 60% of the company's total revenue, entirely missed market expectations.
And when a budget-friendly brand like Old Navy misses, the immediate assumption is that the lower-income consumer has hit a macroeconomic cliff.
Right. But CEO Richard Dixon was adamant that the consumer is still spending. The data shows Old Navy simply bet wrong on spring and summer dresses and swimwear. Consumers were enthusiastically buying activewear and denim instead.
So it's a stark reminder that when apparel companies blame the broader economy for a bad quarter, they are frequently just masking simple inventory mismanagement.
Exactly. The consumer is definitely still spending, but they are altering their targets. We are observing the classic lipstick effect playing out in real time, but substituting cosmetics with sugar.
Oh, the New York City candy boom.
Mm-hmm.
New York is experiencing a massive wave of boutique candy stores opening up.
Yeah, the underlying economic theory is that when individuals feel squeezed by housing costs or inflation and delay buying large luxury items, they substitute those purchases with small, highly accessible treats.
So consumers who cannot afford a European vacation are buying premium imported sweets to secure a minor psychological boost. But even those small comforts are colliding with the global supply chain friction we discussed earlier.
Right, because the wholesale cost of a standard Hershey bar has officially crossed the $1 threshold for store owners.
Which is wild. And that extreme price hike is driven by two distinct macro factors, compounding simultaneously President Trump's aggressive import tariffs and the elevated global transport costs lingering from the recent Iran conflict.
Because cocoa beans must be imported, domestic candy brands are facing severe margin compression just to get the raw materials into their factories.
And that specific supply chain blockage is driving a fascinating micro-trend. Imported Swedish candy stores, like the brand Bon Bon, are expanding rapidly across the United States.
Yeah, because Swedish confectionery relies on an entirely different set of ingredient supply chains and manufacturing bases. So these niche businesses are finding unusual expansion opportunities.
They're taking over small side street real estate where rents are manageable and completely bypassing the cocoa tariff constraints hitting domestic chocolate manufacturers.
That theme of intentionally altering your business model to survive a brutal macro environment isn't just happening at the local candy store either. It is actively freezing an entire global capital market right now.
Use South Korea. The equity market there is experiencing a massive systemic freeze. By early June, the country had seen only 15 initial public offerings.
15 is basically nothing for an economy of that size. And the root cause is entirely structural. South Korea imposes a 50% inheritance tax on amounts exceeding roughly $2 million.
And that inheritance tax creates a perverse incentive structure for the massive family-run conglomerates, the cables that dominate the South Korean economy. Let's break down the mechanics of this, because it operates almost exactly like a homeowner trying to game their property taxes.
That is the perfect way to look at it.
Right. Imagine a homeowner who intentionally refuses to paint their house, lets the roof sag, leaves the lawn dead. They do this because they know the city assessor is coming and they want the property valued as low as possible to save on taxes.
So the homeowner saves money, but they are actively destroying the property value for all the minority shareholders who happen to live in the guest house.
Precisely. And the cable families are executing that exact strategy on a macroeconomic scale. They're strongly incentivized to intentionally keep their corporate valuations suppressed and their free floats low.
By making the company appear less valuable on paper, they minimize the eventual tax burden when the controlling stake passes to the next generation. They are prioritizing familial tax avoidance over generating value for their public shareholders.
Which is incredibly frustrating for investors. The South Korean government realizes this dynamic is destroying wealth, so they launched a corporate value-up initiative. They're actively threatening to delist hundreds of insolvent or intentionally suppressed companies.
The goal is to force better corporate governance and direct capital toward emerging sectors, particularly new AI infrastructure firms. But unless they actually change the tax incentives, threatening delisting seems like putting a Band-Aid on a structural wound.
It really does. Moving from the intentional suppression of legitimate value, though, we have to examine an underground economy that is extracting wealth with terrifying efficiency.
You're talking about the recent summit held by the UN and Interpol in Vienna. It revealed that global fraud has ballooned into a $500 billion industry.
$500 billion. This is no longer a scattered network of individual actors. It is a highly industrialized, multinational shadow economy. The logistical complexity of it basically rivals legitimate global supply chains at this point.
It does. The summit highlighted a recent case involving a UK victim who lost roughly $107,000 in a romance scam. And the way the physical assets and the stolen funds move through a highly coordinated international network is chilling.
Yeah, let's trace that path. The victim purchased a mobile phone in the UK and shipped it to an address in Cyprus. That physical device ultimately surfaced in Nigeria. Meanwhile, the stolen capital was routed through money transfer services in Romania.
And the entire operation was facilitated by a sophisticated, entirely fake banking interface registered on a server in Baltimore, Maryland.
It's a truly global operation. But the labor force driving this $500 billion extraction is just tragic. Investigators detailed how scam compounds operating in places like Myanmar and Cambodia are heavily staffed by trafficked workers.
Yeah, these individuals answer seemingly legitimate job advertisements for customer service or IT roles. Then they are transported across borders, have their passports confiscated, and are forced to meet daily financial extraction targets.
They are actively stealing money from victims in wealthy nations under the constant threat of physical violence from armed gangs. And this massive drain of global capital compounds the severe fiscal pressures currently suffocating governments.
Oh, absolutely. Look at the UK. Incoming Prime Minister Andy Burnham is inheriting an absolute fiscal nightmare.
Yeah, the roughly $32 billion fiscal buffer that the Treasury previously modeled was entirely eroded by the economic shockwaves from the Iran conflict. Burnham now has to balance urgent pledges to stimulate domestic economic growth with a mandate to hit massive defense spending targets of 3.5% of GDP by 2035.
And balancing defense spending against domestic welfare is becoming mathematically impossible for many sovereign budgets. Burnham is staring down ballooning welfare obligations, specifically the state pension triple lock.
Right. That mechanism guarantees that public pensions rise by inflation, average wage growth, or 2.5%, whichever is highest. It's a massive compounding annual payout increase. So governments are struggling to fund basic infrastructure while $500 billion globally is being siphoned off by criminal networks.
Which brings up a deeply skeptical question regarding international policy. Wealthy nations constantly demand that developing nations shut down these scam centers.
But how can we realistically expect local governments to crack down on these industrialized compounds when they lack basic state resources? And the scammers are operating in remote regions, effectively controlled by heavily armed cartels.
South African prosecutors at the Vienna summit raised that exact counterargument. They pointed out that wealthy nations demand immediate action but fail to share the forensic accountants, the cryptocurrency tracking experts, and the open-source intelligence platforms required to actually dismantle these networks.
Developing nations simply do not have the technological infrastructure to fight a sophisticated transnational cyber war on their own. But the technology sector is finally recognizing the scale of this threat, and it is immediately showing up in corporate earnings.
Right, cybersecurity firm Okta recently saw an 8% stock jump, and that was driven almost entirely by corporate demand for agentic AI security tools.
Agentic AI. That represents a fundamental shift in cyber defense, doesn't it?
It does. Unlike traditional software that simply flags a suspicious login for a human to review, agentic AI operates autonomously. It can make decisions, take actions, and actively lock down systems in real time.
Because corporations are realizing that the cyber threats are becoming automated, so they require autonomous AI defenses to verify identities and fight off attacks at machine speed.
Exactly. The defense has to move as fast as the attack.
Well, looking across this stack of sources today, we're witnessing distinct economic developments pulling the global market in totally different, often contradictory directions.
You have AI infrastructure generating unprecedented software-level profit margins on physical hardware. You have traditional retail brands struggling to figure out why consumers will buy denim but refuse to buy summer dresses.
And you have an industrialized shadow economy adapting to global financial constraints faster than sovereign governments can even coordinate a response.
The connective tissue linking these disparate stories is structural adaptation. Everyone is trying to find a workaround.
Right. Whether it is a semiconductor giant structuring specialized debt to finance hardware sales, a warehouse retailer using cheap gasoline to lock in recurring subscription revenue, or a stressed consumer buying imported Swedish candy because a vacation is out of reach. Every layer of the economy is actively adapting to physical and financial limits that didn't exist a few years ago.
It is adaptation on a massive scale.
Which brings us to a final, slightly surreal thought regarding exactly where all this adaptation is taking us. Amazon's autonomous vehicle division, Zoox, just unveiled a redesigned robotaxi.
Oh, I saw this. They plan to start charging passengers for rides in these vehicles later this year.
Yes, and the vehicle has no steering wheel, no pedals, and is essentially shaped like a giant futuristic toaster. It perfectly encapsulates the bizarre nature of the June 2026 economy.
A driverless toaster taking you across town.
Exactly. You are living in a world where you might find yourself actively stressing over the inflated, tariff-driven price of a wholesale Hershey bar, while casually using your phone to book a ride in a driverless toaster. The future of money and markets is clearly going to be incredibly weird. Thank you for joining us today.